now we're in this period of, maybe deglobalization, or at least we're not globalizing the rate we were. Even if we keep our gains, we're not just rapidly globalizing anymore. Um, and so we have, and then now we have much higher debt to GDP than we had before. So even smaller gains in interest result in much larger interest expense relative to the size of the economy from the public sector. Um, and so I think that the same concerns that were present in the late 80s and early 90s are 30 years later reemerging their head. And this time there's no offset.
In recent times, growing concerns surround the fate of the United States economy and its impact on U.S. investors in the coming years. A significant issue is the rapidly growing debt spiral, which experts predict will worsen with no clear resolution in sight. Additionally, worries persist about the U.S. dollar's fate on the global stage, as the BRICS nations work to challenge its status as the world's reserve currency. These economic challenges are further compounded by deep political divisions within the country, making it increasingly difficult to find viable solutions to the ongoing economic issues. Lyn Alden, a renowned investment strategist and macro analyst, highlights that the roots of the current challenges go back to the 1980s, when the national debt surpassed the $1 trillion mark. Despite various factors, such as globalization and favorable demographics, helping sustain the economy and manage the growing debt, these supports are now unraveling rapidly or occurring at a slower pace, leaving the U.S. economy in a precarious state and on the edge of disaster. In a recent discussion from Blockworks Macro, Lyn Alden provides a vivid analysis of the situation, with excerpts from his July 2023 newsletter shedding light on the severity of the current economic predicament.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We can go back a couple decades to have a little bit of insight into this. So in the late 80s, due to the attempts of the Fed to fight inflation by raising rates so much, and then you had during the 80s, partially for the Cold War and other reasons, you had Reagan building up quite a bit of public debt. So we went from 30% to way above that. And so the combination of high rates and large deficits did start to actually cause quite a lot of interest expense by the government after a long enough period of time. And the late 80s and early 90s was kind of the peak period back then for concerns around the sustainability of public finances. So that the famous debt clock was put in place in the late 80s. And then you had Ross Perot run the most successful independent campaign in modern history, and his big thing was the debt. And so that era, the zeitgeist was really, you're hitting like $1 trillion numbers for the debt. It's completely unsustainable, and they ended up being like 30 years early because right when they were like in their crescendo of how bad this is, and all their reasoning was right, but then you had the fall of the Soviet Union, opening up of China, and you had this kind of 30-year period from, say, the early 90s to the late 2010s of rapid globalization. So we brought on 1 billion people into the global capital labor force. Western capital and Eastern labor all kind of come together. You had this profound period of productivity. You had structurally lower interest rates for decades, which then allowed that debt, so that even though the debt to GDP kept increasing, the interest expense relative to the size of the economy was flat to down. You had peak demographics in the U.S. So in the late 90s, early 2000s, you could run a surplus because those baby boomer generation was in now their peak like earning yield years, and so basically for 30 years, like those guys looked really really wrong, and then you started the zeitgeist came to be the debt doesn't matter. Look at all those people that were alarmed about it. It's not really an issue. And I think the challenge is that, going back to your question, that 30-year period is kind of behind us now. The same concerns that were present in the late 80s and early 90s are 30 years later reemerging their head. And this time there's no offset. There's no, we can't have another 30 years of structurally lower interest rates. We don't really have another 30 years of globalization. We have some productivity offsets from, AI and software and things like that. But when it comes to labor and energy and things like that, those are real constraints. And so I think in general, we're going to face more average inflationary pressure. The debt's going to be more of a political thing. I think you can see the politicization of interest rates. We've already seen it. Some example, we have Elizabeth Warren grilling Jerome Powell in Congress
Yeah.
I think you could have similar dynamics where you get political parties based on the interest rates become more of a partisan issue. And as far as the end game, I think the big question comes down to whether or not they're able to reset this and keep it going, or if this is just kind of an era that ends and we enter a new era for money. Um, and so if they're able to kind of do what Israel did decades ago, or do what a lot of developed countries did in the 40s, and they say, okay, we're going to burn a lot of this debt off, and then we're going to pivot and we're going to get austere. That's kind of the bullish case for how this ends, which is, cash and bond holders get killed on a real basis, things stabilize, and then we kind of build from there. Or, we enter just a whole new era where the dollar kind of enters a spiral. There's not enough political unity to do anything about it. It just keeps getting worse and worse. And you probably want to own things like Bitcoin and gold and, hard assets. And we enter kind of we go through the looking glass.
In her newsletter, Alden draws a compelling analogy between the future of the United States economy and Lewis Carroll's novel, Through the Looking Glass. She likens the Federal Reserve's strategy of addressing inflation resulting from fiscal deficits, rather than bank lending, to Alice standing at the mirror's threshold, contemplating a life-altering leap. When sovereign debt is low and bank lending dominates money creation, higher interest rates slow down loan creation and control inflation. However, as fiscal deficits play a more significant role alongside bank lending, the impact of higher interest rates becomes uncertain, creating a delicate balance. According to Alden, the United States currently finds itself in a crucial stage, with annual fiscal deficits already exceeding annual loan creation. This situation creates a tug-of-war where higher interest rates can both suppress private sector lending and increase the deficit. Alden warns that if the trend continues, the economy may progress to a stage where sovereign debt becomes extraordinarily high, and fiscal deficits outweigh bank lending as the primary source of money creation. At this critical point, higher interest rates could be correlated with inflation, leading to an unstable economic situation. In this challenging economic environment, Alden discusses investment strategies tailored to address the uncertainties and potential risks ahead. She emphasizes the importance of understanding and adapting to the evolving economic landscape to make informed investment decisions.
So I think when you look at, say, stock market capitalization to GDP, for example, and other valuation measures, I think we've probably seen the peak. Um, and I think that a lot of these crowded areas are not going to have great returns on a real basis. Depending on what inflation does, they could have positive nominal returns. But I think you're looking back a decade from now, we're looking back from the peak in late 2021. I think that the inflation adjusted returns from some of these major asset classes is not going to be very attractive. And the question is, are some of these other asset classes going to be able to provide some degree of alpha? So I think Bitcoin is an attractive one. Gold is challenging, but if you do enter a really truly kind of sovereign crisis, gold is one of the things that central banks can use to basically recapitalize their system. So I think gold is another one to have a position in. And then looking out, I mean, I do think that there are areas like Brazil or India, some of these kind of third-party emerging markets that I think that there are kind of interesting long-term, like decade-long opportunities. And I don't think that the energy trade is done yet. We haven't really seen even a capex cycle, right? So we've not seen, for example, a whole nother cycle of bringing more oil online. And in general, even though we saw this big spike in oil and this big fall in oil producers kind of never really followed that spike. They never got over enthused, and then as the oil came back down, they're still appropriately priced for the current level of oil. And so, we're seeing early signs that U.S. shale is running into headwinds. So as you've seen lower oil prices and recessionary concerns, there's not a lot of reinvestment. That what makes shale oil different than these other resources is that you need rapid reinvestment in order to keep that production up. You get oil quicker, but you need to reinvest more frequently. And we're seeing rigs go down, the number of rigs. And generally, when you see that decline in rate of change terms, usually energy production, oil production, peaks some months later. And so we're kind of seeing initial concerns that we might be getting somewhat towards the top of our oil production range, at least in this cycle. Um, and so I still think in general the energy and commodity space is interesting. You just have to volatility manage it, right? Because if you go through a recession, if you go through other periods, it can do very poorly. But I still think that's an asset class for this decade. And kind of the way I'm describing it is when we think of the 60-40 portfolio, the problem there is that both bonds and stocks like disinflation. So bonds obviously like disinflation, and then stocks, they like structured lower interest rates and no constraints on materials and things like that, so that all these big mega cap stocks can just keep growing and getting higher and higher valuations. Now, one way to augment that portfolio is to have a section that is kind of a defense against inflation. So it could be energy, could be um, copper, materials, things like that. Could be hard monies like gold and Bitcoin. When you have that slice, it helps you, I think, protect the other two slices in a portfolio. Instead of having all of your portfolio geared toward disinflation, have some of it that's geared towards disinflation, but then you have a segment of it that's geared more towards inflation, so that no matter what happens, one segment will probably be carrying the other segment.
In light of the uncertainty surrounding the future of the United States economy and investors, Alden draws attention to a potential scenario akin to Japan's experience. Japan serves as a major example of a country that has already gone through the looking glass, rendering interest rate hikes ineffective in combating inflation. Japan's public debt, amounting to about 250% of GDP, showcases the significant impact of even a slight increase in the weighted average interest rate on their fiscal deficit. Alden highlights several factors that could exacerbate the situation if the United States follows a similar path. These factors include Japan's aging population, which occurred ahead of other countries during a period when China's inexpensive goods helped offset labor shortages. Additionally, despite a median age that is 10 years older, Japan spends less than half of what the United States does on healthcare per capita. The looming increase in per capita healthcare costs for the U.S. when it reaches Japan's average age may prove challenging. Furthermore, the U.S. spends a higher percentage of its GDP on the military compared to Japan, and geopolitical conflicts are escalating during this time. In response to these challenges, Alden recommends owning hard assets like Bitcoin, describing it as an ideal asset to weather the storms the United States may face. She suggests holding actual Bitcoin for exposure and learning how to self-custody it. While Alden doesn't have a firm view on Bitcoin's short-term price, she expresses bullishness in a 2-year view and beyond. What are your thoughts on Lyn Alden's assessment of the current state of the United States economy and what may lie ahead? Feel free to share your observations and comments in the section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.